Thank you very much. I think what Sam said is got to be right when you look at the SME financing framework today. We would actually go one step beyond by saying, once again, that bank lending is not the right tool for financing SMEs, and for a number of reasons. But the first reason is, as little as bank lending may be involved today in SME financing, whatever little that is going to continue to shrink very fast over the next 6 to 8 years for a simple reason: accounting. If you look at Basel III, which comes into effect 7 years from now, Basel III effectively forces banks out of the SME financing business, whether it's balance sheet funding or financing, whether it's even the trade financing aspect of SMEs, without even considering returns and actually the pressure that banks are under today to massively deleverage. We have to face the reality that even going beyond the sovereign powers that any nation in the EU, the UK, and other countries have in terms of pressuring or putting pressure on their banks to lend to SMEs, they're simply not going to be able to do it for basic accounting reasons. Now let's look at SMEs now and what they mean to the UK economy in particular. We like to talk about them in the European context. There are 23 million SMEs in the EU and 22 million unemployed people. In the UK, we've got 2.5 million unemployed. We've got 4.8 million SMEs. If we look further down, obviously many of these SMEs are, single person. They're basically artisan, tradesmen, independent workers, if you want. But if you look within the SME ecosystem, there are some very, very interesting statistics as to how they are currently playing a role in creating value added within the UK economy. If you look at companies employing between 10 to 250 people, they represent 12% of UK corporates, 12% of the employment, 12% of the number of companies. But they represent 36% of national value-added creation in the corporate sector. So if you put the state aside, a third of value creation, a third of the economic contribution to the UK comes from the 196,000 companies that employ between 10 and 250 people. This is where jobs are going to come from. Jobs are not going to come from blue chips. They're not going to come from government. So we're talking about growth, future growth, referring, of course, to employment growth. The SME sector is the only sector, not one of the sectors that's going to contribute to job growth. It is the only sector that is going to contribute to working towards eliminating those 2.5 million unemployed people in the UK. And why is that? Because SMEs, and I'm very much looking forward to hearing from Will in a minute, SMEs innovate. And the fundamental contribution to the capitalist economy in terms of value creation, of course, is based on innovation. And what is the primary tool for the financing of innovation? Of course, it is not debt. Never has been. It has always been equity, which, by the way, as an asset class, as a financial tool, was invented here. So if you're financing a startup, if you're facing the risk of that company effectively not surviving, equity is the right tool. Equity does not deplete the income statement to pay for interest, to cover the interest. Equity does not require a lien on the assets of the companies. And equity, of course, provides unlimited upside, which is exactly the same risk framework that SMEs, particularly at this startup stage, provide. A lot of upside and also potentially a lot of downside. That's the right financial tool, not fixed income. If you're a bank, and if you're lending to an SME, and if your debt is capped at whatever it may be, 6, 7, 8, 9%, you're not going to match your potential losses with a potential reward. So for startups, for innovation, it is time, we believe, that the treasuries within the EU rediscover equities, rediscover the fact that debt today attracts deductibility. Yes, debt is today subsidized by taxpayers. And yet, it's true, every crisis we go into, certainly in the last 100 years of our modern capitalist history, has been induced by an excessive recourse to debt. Another debt-fueled binge, which, by the way, happens to be subsidized by taxpayers. Our inability to monitor leverage remains the fundamental weakness of our capitalist economy, not its ability to create wealth. It's the boom-bust cycle that people don't like, that makes protesters basically set up their tents, seeking to occupy the space in front of the stock exchange. It's the boom-bust cycle. It's not the ability of capitalist economies to create wealth. So we need to wean ourselves from debt, certainly in terms of the tax deductibility of debt on one hand, and on the other side, the literal clobbering that equity is suffering at the hand of the taxpayer, whether you look at dividends, whether you look at capital gains, whether you look at corporate income tax, whether you look at stamp tax, which now may be superseded potentially even by a financial transaction tax, which raises the cost of raising equity, which lowers the average size of the pension fund. So we need to rebalance that system to stimulate sources of finances that are suitable for the financing and innovation. But there is a role for debt for larger companies. Once a company has set itself up, has established a track record after 2 or 3 years, those 196,000 companies that have between 10 to 250 employees, and the companies that are larger than that, they also need debt. A year and a half ago, we launched a market in the UK, which didn't exist before. There was no electronic market to fund companies through debt issuance. And that market is a retail-enabled corporate fixed income market. So far this year, we've raised a little over £1 billion. It's a new market, started from scratch. But because it is retail-enabled, because it allows investors to commit through investments in bonds, sums as little as 1,000, in some cases as little as a single pound, we've been able to raise, together with the broker-dealer community and the financial services community attached to this market, to raise chunks of debt as small as £25 million for small companies. We've raised debt for NGOs, for housing associations. We do have there a structure, when one is looking at debt, that we believe will be in the long run much more efficient than bank finance, for a simple reason, and very pleased that 2 weeks ago Barclays announced their commitment as a sponsor of that market. And it helps them in more than one ways. It helps them because we have now found a source of debt finance for SMEs that do need debt that does not include leveraging banks' balance sheets. Makes a lot of sense for Barclays. Where we need our market makers, where we need our issuers, and of course, where we need our investors. But let's not think for a minute that there isn't cash around. There's €1.5 trillion of unspent cash resources sitting on the balance sheet of corporate European companies. There's a lot of money in the retail sector, there's a lot of money in the institutional sector, a lot of cash looking for growth. And we believe very strongly that this market, which is an innovation in the UK market, which traditionally has been an over-the-counter wholesale market, this is anything but that. It's a listed, transparent, visible market that matches retail and institutional investors and corporate issuers. And we feel very, very good about this market's prospect for a simple reason. 3.5 years ago, we launched the same market in Italy, which has a very active and vibrant retail market. It's a market called MUT. As you can understand, we weren't going to use the same name here in the UK. This market trades €2 billion a day of liquidity, and it's geared towards raising bonds, raising fixed income finance for SMEs, so it can work. And we believe that with a renewed focus here of the government, of the UK administration, on SME financing, there's a better than excellent chance for this market to take off very soon.